Welcome to Outlook Money's interview series, Wealth Wizards, where you'll find money maestros in conversation with me, Nidhi Sinha, editor, Outlook Money. In this series, I meet experts you've always wanted to listen to and learn from. Today, I have with me Mr. Shankar Sharma, founder of GQuant and First Global, who's often referred to as the big bear of the Dalal Street. With Indian markets at all-time highs after dithering slightly after the general elections, it is interesting to find out how long will the bulls keep running. The international market has already had a taste of it with Japanese stocks crumbling recently. So let's get straight into this interview with Mr. Sharma, who may help us understand the market direction, what we can expect, and how we should strategize in these conditions. Welcome to the show, Mr. Sharma, and thank you so much for joining Outlook Money for this interview. So, my first question to you is, you are often called the big bear of the Dalal Street. Like all of us have, grown knowing you by that name. So do you identify with that name, and why is that so?
Yeah, so India is a strange market. I mean, if one has been negative for a period of time, which is very short, by the way, it somehow you get branded as a big bear, and somebody's been bullish, you get big bull. I mean, these are very superficial terms. And the interesting thing is, in India in particular, nobody before I sort of did that, nobody has ever been vocally bearish at any point in time. Here, somehow the popular culture is that we are always supposed to just say good things about markets and never say anything which is remotely negative. If you say that, you are a bear. Now, my style of investing is that I keep a very open mind. I'm very global. I've been investing globally for the last 25 years. And the culture I am used to is in the US, for example, major hedge fund managers, major mutual fund managers, major commentators can be openly negative about markets at different points in time. And they have been. So, and they will bet based on that view. They will go short the market, they'll go short treasury, they'll go short a bunch of stocks. That's a very developed way of thinking, that markets go up, markets can come down as well. It's not that markets are permanently upward trending. They are over a 30, 40-year period, particularly in India or the US. But in the interim, there can be very brutal periods when you can lose literally 20, 30, 40, 50% of your capital. And the interesting thing, again, is we have forgotten in this last 4-year rally that from 2014 till 2020, up until COVID, the market returns from India, I'm talking, were less than bank fixed deposit returns. And for small caps, the less said, the better. From 2018 to 20, it was a brutal small cap bear market in which stocks basically got decimated 50, 80, 90%. So, we have forgotten those times. We are just living in the good times, and we kind of believe that anything which is remotely bearish is not possible. So that tag stuck because I was bearish only twice, which was 2000 and 2008. And believe you me, I have made more money being bullish than being bearish, but being bearish has saved me a lot of money, particularly in those massive falls. So being bearish at the right point is very strategic. It is not about making money. It is about saving the money that you have made.
Right. So you are talking about this, especially, there is a lot of hoopla about the market going up, and it is going up consistently this year. So do you think these times are really actually the times where investors should be more careful than other times?
So here is the thing, that you should always be careful. I mean, investing stock markets are not really things which are, things you can look at a bank fixed deposit that I will get 7% irrespective of, whatever economic cycles that happen. Stock markets are basically about risk. When we are today sitting in the 5th year of a bull market, we started, remember, 2020 March is when we started the bull market. Now we are in the 5th year. We have entered 2024-25. When you have entered the 5th year of a bull market, statistically, most markets tend to start to correct or wobble or become somewhat nervous. And that's only because markets have run up so fast, so hard for such a long period of time that usually markets take a bit of a breather, a stumble in year 5. We are in year 5. I'm not saying it happens today, But I would be very, very circumspect in my decision making today than what I might have been in March 2020 or April 2020 or pretty much the whole of 2020 when we were coming out of a 6-year bear market prior. So when the market started to rally, I was clear that this is going to last for a few years because very important, Nidhi, is to understand the length of a bull market is almost directly correlated by the length of the preceding bear market. So if the preceding bear market has been 5-6 years, the succeeding bull market will be around that time, if not a bit more than that. So 2014 to 20 was a period of subpar, subnormal returns. When the bull market, this one started, I said, okay, 2-3 साल तो problem nazar nahi aata hai boss, because 6 साल हम लोग ने मंदी झेली है. Now we will see at least 3-4 years of a decent bull market, and fortunately, by God's grace, that view came out right. Now we are in the 5th year, and now because we are in the 5th year, we are going to be a bit more circumspect. It will not be as smooth a ride as we have seen in the last 4 years.
Right. In fact, earlier this year, you said that, over-capitalized stocks may fall 90% when there's a bear market. So do you still hold that view?
Oh, absolutely. So, I have seen markets for a very long time. I can tell you in a bear market, whenever that happens, two kinds of stocks fall. One, stock with a lot of leverage. Okay. So where the debt equities are through 2, 3, 4, like infrastructure, construction companies and all that. Second, they happen when instead of debt capital, a company has excess equity capital, which they raised in the bull market, but they found no good use for it because people raise money in bull markets because not necessarily because they have any use for it, but because it's coming your way. That's wise, but up to a point. When you take too much capital in, okay, and many companies, smaller ones in particular, have been taking a lot of capital because that's available. That capital is usually frittered away in doing silly things, okay? Or at least it does not earn a decent rate of return. Those kinds of companies get hurt a lot in a bear market. They can be decimated 70-80%. It's as bad as having too much debt. Too much equity is almost as bad as having too much debt.
So these are mostly small caps and mid caps that you're referring to, is it?
So the large part of the fundraising and the euphoria has been centered around small caps. I mean, there is no debate about it. Large caps have really sat out the whole rally in any meaningful way. I mean, they will obviously go up, but nothing compared to what the small caps have done. And if that is indeed the situation, then the over-capitalization gets centered around the small caps. Remember one more thing. The small caps, in order to become big caps, large caps, have to raise money. They need money. Question is how much. There is always, it's like exercise, medicine, sleep. Everything has got a certain ratio in your life. If you have too much of it, good food. If you have too much of it, is when you have the problem. I'm not saying don't raise capital. Please do. But don't raise so much capital that you become profligate with capital. And that's what is going to happen.
So continuing through the same refrain, as in the valuations are very high, but still investors, they are willing to invest more, even perhaps FIIs also and DIIs also. So is this a cause for concern? Like, more and more money is coming in, and recently the company's growth have been muted. Maybe that's why. So what do you say about that?
So one concern I have, and let's talk about concerns a bit, is that numbers this quarter have not been super good. In many, many companies, large, mid, and small, I've seen a moderation of the numbers. I don't know whether that is, indicative of a generalized slowdown. I hear very conflicting views. So I've still not made up my mind whether it is structural or is it just like a blip or what, whatever it is. But that is a fly in the ointment. The second point is we are now in a situation wherein the government has and professed and proclaimed that they are going to reduce the fiscal deficit. Once the fiscal deficit starts to ratchet down, growth will inevitably slow down. And one view that I hear from informed quarters is that this year you could actually disappoint. We could disappoint on the GDP growth numbers itself. We may not hit 7.2%. We may end up with more like, under 7%. Now, it may not matter much, but just optically from 7.2, if you're 6.9, it can be viewed very negatively. I think there are those little things on the horizon. But again, I must caveat this by saying GDP growth hurts large companies more than small companies
I see.
because they are driven by the big headline numbers of GDP growth. For small companies, you're dealing in small areas, one town, one state, etc., etc. They are not necessarily directly exposed to the macros of the country. They are, but much less than a large cap company.
So, but you were also mentioning that, it's a 5 year or 4 5 year cycle of a bull run, and especially it correlates to the previous cycle. So when do you predict the bear market will hit us?
I don't think we will have a bear market. I don't think we are ready, ripe. I don't see conditions that require a bear market, that merit a bear market, because bear markets necessarily follow a giant bubble. The only bubble you can argue is in the small cap SME IPOs and all that. But other than that, I don't see a generalized bubble out there. If there's no bubble, what you will get is a moderation, but not a collapse. Moderation cannot be called a bear market. You might have a sideways market. You might have a 10-20% decline in the market. I don't call that a bear market. A bear market, in my view, particularly in a country like India, might be 30-40% lower. So that's really something that will be called a bear market. But I don't think it's happening anytime soon
Anytime.
at all.
Okay, so you've always also been heard talking about this new capital gains tax, the budget announcement that those can create kind of hurdles which can accelerate the journey towards the bear market for India. So it's been more than a month after those changes. Of course, there have been some tinkering also, especially on the real estate part when it comes to capital gains tax and removal of indexation, etc. So. Has your view changed after a month? Do you think things settling down again, or the tax reforms are also on the anvil? So, is it a wait and watch? How do you see it?
So I've been against increases in capital gains tax in equities for the simple reason that I believe that ultimately it is a risky asset. The government is believing that it's super easy to make money in the stock markets, as probably everybody else is. And I think they have got carried away by that belief that kitna aasan hai, to fir why should it not reach a more normalized level of tax? So agar income tax 25% hai, to isko 20% kar do. I think that is a mistaken notion. Stock markets are volatile animals. Plus, we still need a lot of capital attracted to the stock market. Both factors require moderate tax rates. So you can say that from 10 it will become 12 or whatever it will. It's still a 25% increase. Okay. And the fact of the matter is we need capital formation. We need to encourage retail investors to stay in the markets. All of that is incentivized by having very moderate tax rates. So I have been against it. I continue to be against it. But I mean, it is what it is. It's been done. I hope at some point they revisit it, maybe in the next budget or the budget afterwards.
But do you think that, you mentioned that the government is thinking in a particular way, perhaps it's thinking that, the gains can come easy in the stock market. Do you think the retail investors can actually be affected by that sentiment and become not exactly reckless, but maybe not that responsible with their money?
The nature of investing, Nidhi, is that we always become reckless in elevated bull markets. That's human nature. We become more easy. It's just like you believe that everything is so simple. It's a slam dunk. Anything you touch will turn to gold. We are in that situation. I mean, let's face it. But I mean, I've seen many such situations. I'm not surprised by it.
Yeah.
This will pass. People will get hurt, especially people buying IPOs of companies with 2 Yamaha dealerships and stuff like that. But I mean, again, I don't see why that should be a big problem. I mean, this is a market in which buyer beware. If I buy a stock and the stock goes down, that's my money, and I should be and prepared to witness those situations. Retail investors, the problem, if they lose money, then they'll blame SEBI, regulator, finance ministry, prime minister. I'm sorry, you cannot blame anybody. You put your money. Okay, the only guy at the highest you can blame is your advisor, if you had one, who asked you to put money into X, Y, or Z. If you had nobody and you saw some news report and did it, Too bad. I mean, learn to live with your mistakes. Learn from your mistakes. We all have made mistakes. We all have lost 80-90% investing at certain points in time. And that's the part of the learning process. So I don't think making losses such a bad thing, being reckless such a bad thing, as long as you learn from them. And that's the ultimate point. Learn from them, become better the next time. But don't play the blame game of blaming the whole world for your problems.
Right. So, though you are saying that, the bear market, it's not a bear market that we'll see anytime soon. But in your experience, in general, what are the signs that point towards a bear market or rather a bull market as well?
We are in a bull market, so we don't need science. For a bear market, a more generalized bubble. So, companies with no fundamentals raising a lot of IPO money, uh, bubble territory valuations in the markets, all of those, of course, these kinds of crazy over subscriptions in the SME space. All of those are signs. They don't mean that we have like a pervasive bear market. What it might mean is we might have a localized, very, very, very pinpointed bear markets in overvalued sectors, in overvalued stocks, and these kinds of frothy IPOs. And I think looking at Nifty valuations, for example, 1820, I think 2022 times earnings, it's not demanding, it's not bubble territory, it's not bear market deserving levels. It might be a corrective level, but not a bear market level. So on a broad basis, there is no bear market. I see corrections, yes and no. We can debate that, but not a generalized bear market.
Okay. Okay. But do you also think that retail investors have the wherewithal to understand these signs? Because, when we work at Outlook Money and interact with people, awareness, of course, is a very key issue, which you also highlighted, that if you don't know what you're doing, then you cannot blame others, perhaps. So, and there is a lot of retail participation right now in the equity market. So where is the balance and what can be done to kind of strike a balance between this so that they can also be protected to some extent?
It's a jungle. The only thing you can ask for protection from is there is outright fraud, or companies are coming to the market or doing IPO where the numbers don't exist. I mean, fakery, fraud. That's the only thing you ask for protection, because the regulator and merchant bankers are accountable. Other than that, I'm sorry. You're in the sea. Please find your methods of swimming safely. Okay, don't just hope that the lifeguard is going to save you if you are going to be swimming way out of your depth. So if you're out of your depth, get back to shore or get a tube, get protection. But don't, again, if you drown, don't end up blaming the world for it. I'm just saying this repeatedly because for retail investors, the biggest flaw I see is that they will find XYZ to blame rather than taking and accepting their own mistakes. Okay, we all make mistakes, but I have made mistakes in my journey many, many times, and I will continue to make mistakes. The point is, I don't blame anybody. I take my losses, I bite the bullet, I learn from it, and then I put it away. It's gone, it's finished. It's like a bad game. It's like a bad period in life. Learn from it, but don't end up playing the blame game, turning bitter, कि सब चोर है, market rigged है, market fraud है. ऐसा कुछ नहीं है. Our markets are very, very democratic. Our markets are very transparent. I can tell you this. I've been around 35 years. I mean, it's a privilege to have been born in India and to have been blessed with a market as good as this. So let's not, blame कि पूरी दुनिया मेरे against है. It's not that. If you are foolish, you lost money because of that.
So could you just list 3 things that investors should be cautious about, or they should kind of consider before entering the market, whether it's a bull market or a bear market?
My mantra is simple. My mantra is do not have concentrated positions. So I have no problem in buying speculative companies with not great fundamentals. I buy them. I mean, that's the way I look at investing. I don't want to buy Hindustan Lever or HDFC Bank today. Okay, I might have bought them 25 years ago, but not today. I'm in the business of making outsized gains. If I'm in the business of making outsized gains, I should also be prepared for outsized losses. So I have no problems in taking a high risk strategy, but the high risk strategy is really problematic if you put all the high risk into a single stock or just 2 or 3 stocks. The problem lies there. If you buy, trust me, if you buy a bunch of 40 high risk companies, okay, you will do very well.
Okay.
Because high risk doesn't mean that all the risks become real and all the risks become, they actually transpire. High
Mm.
risk means there is risk, but there is also return. Now, some of them will fall, some of them will turn out to be duds. But 4, 5, 4, 5 will come out such with such flying colors out of that 30, 40 stocks that you will look back and say that I was fine playing a high risk strategy. The difference was capital allocation. I just allocated 1%, in each position, and then let the winners run. So that is the mantra I follow. I follow now. And I would heartily recommend that to people that please, by all means, play a high risk game, but diversify the high risk game. Don't concentrate the high risk game.
Right. So that is one big learning that our viewers have today. But now I'm coming towards the end of this interview, and I would like to ask some of your personal experiences. So one is that, of course, you've been investor for so long, and in our professional journey, like I mentioned earlier, we've learned a lot from you. What is the best investment you think you've made over the years? It might be difficult for you to say one. You could always list more than one.
No, so Amazon is the one that is dearest to heart. I mean, it ultimately ended up making about 200 times over a 20-year period. But I can tell you only this, Nidhi, that it was largely a product of luck. There was an initial thinking and hypothesis why we ended up liking it, but that it would do so well, nobody, even Jeff Bezos, could not have predicted that. So we tend to romanticize a great stock trade. Reality, the large part comes from luck. We play many stocks. A few of them turn out to be out of the park sixers. Amazon, for me, turned out to be one such, out of the park one. So, I have fond memories of it. I mean, out of it, I don't own it now. But, and I hope the next one comes along for the next 20 years.
So, what would you say about your investing journey over 35 years, like you mentioned? How have you evolved as a person, as an investor?
Oh, I've changed completely. I mean, I cannot recognize myself from today to even 5 years ago to 20 and 25 years ago. And the largest part of the change has been the way I diversify more than concentrate. In the initial part of the investing journey, we were taught that concentration is the way to make money. But the reality was that's extremely dangerous advice. And it was just the worst thing you can do is to concentrate, because concentration means, 2, 3 stocks account for 80% of your portfolio. And most of the time, you're not that lucky. You will make it, you'll get it wrong. And then you're down again. Over time, diversification has become a central mantra, and I abide by it. I swear by it. So I'm prepared to play a very high risk investing game. I've been bullish on small caps, as you alluded to.
So, coming to the end of this interview, I'll ask you something about you again, which is that we all know Shankar Sharma, the investor. But who's Shankar Sharma beyond it? Because I was just going through your Twitter before your interview, and your description on Twitter mentions, Rafi, Jagjit, and Sahir, all of them my favorites as well. So I
Oh
thought I
wow!
should definitely add something, add a question on this.
Oh, I mean, I'm absolute, and I say whatever I've said very truthfully. I'm an absolute fan of these three artists, and they have given us countless hours of pleasure. But it's important to have a lesson in that, Nidhi, and which is where I want to end this interview.
Mm.
That when you make a lot of money, you are not going to be remembered. Okay, nobody remembers very rich people in this world. Okay, how many rich people in the world do you remember? We don't even remember Dhirubhai Ambani that much now. Who
Yeah.
remembers Steve Jobs now? Nothing. When you create something that touches people, like a great artist, a great painter, a great sculptor, a great poet, a great shire, great singer, that is how you're going to be remembered. When you've done something that is very personal to people, not that you made a lot of money, somebody made 500 million, billion, 2 billion, 50 billion. अरे वो तो यार कोई ना कोई तो आपसे ऊपर होगा ही होगा ना. But when you create things which are durable in value, which is touching people every day, maybe you invented a drug, maybe you invented something which people take pleasure from. I think that's what we all people who have made money should also now think that if you want to be remembered, if at all you want to be remembered, This is the way to be remembered, that we are remembering Rafi and Sahir and Jagjit long after they are gone. That to me is real wealth, not the wealth we make in stock markets.
Okay. That's a great note to end this interview. And thank you so much for taking out your time from your busy schedule, Mr. Sharma. Thanks a lot for joining us on Wealth Wizards.
Thank you. Thank you, Nidhi. Thank you for having me.